Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. 2024 was supposed to be the year of the small cap after a few fairly ordinary years. But as we approach the halfway point of this year, it's not looking that much better. So what's happened to the small cap revival? And is there cause for optimism as we head into the second half of the year? Remember, this is general information only, and you should always seek professional advice before making investment decisions. Oscar Oberg works across a number of the LICs at Wilson Asset Management. He's the lead portfolio manager at WAM Capital, WAM Microcap, WAM Research, and WAM Active. Oscar, busy man. Welcome back to Fear and Greed.
Thanks, Sean. Thanks for having me.
Broadly speaking, what's happened to the small caps this last half year, given we started 2024 with so much promise?
Yeah, we did. And I think I was probably I think I've been saying for the last two years or two, almost feels like forever, that it's going to be the year of small caps. And yeah, well, I must admit, my confidence levels around January, February were very, very high, given sort of the feeling around interest rates, following obviously the Federal Reserve's announcements back in December and what we were seeing on the ground when we were seeing companies. And I'd say, what's happened since then has been, small caps have underperformed. And we work in financial years at Wilson Asset Management, but it's 3 financial years in a row. So it has been quite savage. And I think it was heading the right direction really towards the end of March. And then I think, like everyone, we've all been surprised at how sticky the consumer price index announcements have been. And clearly the inflation is here, and whether it's here to stay or not is another story. But certainly the rate cut expectations that were in the market have been revised up, and ultimately that's probably not good for small caps. So we do need, in our view, we need to seek more confidence that rate expectations will come down, which we still believe they will. It's just probably not to the same extent that we all thought 6 months ago.
So is it mostly a macro story rather than sector-specific or stock-specific?
It is and it's not. I think to summarise, if you look at the small cap sector, and we were looking at this the other day, small caps have lost a lot of good companies over the years that have gone to the large cap sector. Some of those companies are Pro Medicus, WiseTech, Steadfast, Seven Group, etc., and they've kept going up when they get into the large cap market because they're going well. Conversely, we've had a lot of, when a small cap goes to a large cap, you get the large caps that are now small caps coming back down. And a lot of them have been sort of companies exposed to the consumer. And that has been a really weak part of the market over the last, call it 3 years. And now I'm talking about companies in the retail sector, automotive sector, and the media sector. There's good companies in their own right, but they've had a difficult patch. So, while we've been giving up companies like Pro Medicus, we've been getting companies like ARB and Harvey Norman, right? And so it's just a totally different mindset and style of company. So you've got that dynamic. And as you look at it within the small cap sectors, around 30% of the small caps are related to the consumer in some way, whether it's building materials, whether it's REITs, whether it's media companies, retail, etc. So effectively, what you do need is you need interest rates to fall because all those sectors should do well in that environment. And we actually did see that from around December to March, as I said before. The other dynamic at play, so you've got effectively small caps, which is largely weighted these days towards consumer stocks. So you need them to do well. But on the other hand, there's still a lot of money coming into equities, and the flows that we see are just incredibly strong, and they are globally. And the dynamic that we've seen in the United States is that the Magnificent Seven, or the large technology companies, I think have been responsible for 50% of the upside in terms of performance over the last financial year in the United States. And the same dynamics here. So as a lot of your listeners will know, the big 4 banks have performed extremely strongly over the last few years. The iron ore majors have been incredibly strong when you consider how many dividends they've been paying over this period as well. And what we tend to have seen is a lot of the large cap companies, they just continually get the flow of money because there's perceived risk towards small caps. So there's 2 dynamics at play here, and which could be very beneficial for small cap companies when it does occur. And that's where we see interest rates fall, demand will return to consumer, but then the money that's been going into companies such as Commonwealth Bank, as an example, might come back into small caps. So you get the double benefit. So that's what we're waiting for. We saw a glimpse of it this financial year, but we think we need to see actual interest rates come down for that real confidence to occur and, for a good period for small caps to happen.
So let's use the Commonwealth Bank as an example. It's extremely expensive on a historical perspective. It's more expensive than the Aussie banks. It's more expensive than most global banks. At some point, so that's arguably it's overvalued. It keeps going up, so maybe not. The market is always right, I suppose. The flip side, though, does this mean that there are some of these small caps which are relatively undervalued?
Well, that's our view. I mean, there's absolutely, when I talk about Commonwealth Bank being expensive, it should be expensive. It's a great company. They're doing everything right. It keeps beating expectations, but it is, when it comes down to it, it is a bank, and it's trading at a price to earnings multiple, I think, of over 20 times earnings. Well, I think most people would think if the economy is weak, then therefore a bank should be weak.
Yeah.
Right. But it is really powered through this period. Conversely, I could buy a retailer today at 10 times earnings, which is half the valuation, and probably has a very good balance sheet. So we just think that tide will turn at some point. Money comes out of a Commonwealth Bank. It doesn't have to go down. It might just stagnate for a period of time. And that money comes back to that 10 times valuation retailer. That suddenly goes back to 14 times, because that's what it used to trade on over the last 20 years. And you make 30 or 40% upside on it just from effectively a reversion back to the mean. So we see a number of companies like that at the moment, and we're not short of ideas at the moment across micro caps, mid caps, small caps. It's just the timing of those ideas is what's key.
Stay with me, Oscar. We'll be back in a minute. My guest today is Oscar Oberg from Wilson Asset Management. So let's push into some of those ideas. I suppose, firstly, is it a stock picker's market? So you need to be pretty active in what you're looking for, or is it more sectoral? And then I'm going to ask you, Oscar, for some ideas for listeners. But firstly, is it a stock picker's market?
Yeah, it definitely is. Because, I mean, I would say, from our perspective, it hasn't been favourable in terms of, large caps have been favoured over small caps. We don't invest in large caps, but we've actually outperformed this year. So, there's been some great stock picking across our team. If I had to pick, the theme that's been consistent really over through the year, I would say it'd be artificial intelligence and how that feeds into technology companies. So companies such as Megaport, NextDC, Life360 have done incredibly well for us, and that's been quite consistent over the last 12 months. I think it's a sector we don't really play in, but the biotech sector has been very strong. So the two companies there would be Neuron and Telix Pharmaceuticals. And the theme that we really played on, which we did really well out of, and thankfully we reduced our exposure there, was what I was saying before, was there was a period probably from around October to March where retailers did extremely well because expectations were very low and the economy probably wasn't as bad as what people thought. And then and of course that's what really drove the small cap sector. But then since around March, April, they expect interest rate expectations a bit higher and a little bit tougher conditions, that's fallen by the wayside. So despite all that, so it's big summary, I would say, tech and biotech, definitely the consistent themes. I think retail had its own theme for a period of time. But at the same point, you can, despite, unfavourable market dynamics, you could call it, an uncertainty, you can still 100%, you can find great ideas and outperform in this market. You just got to work hard at it.
So, Oscar, are there what are some of those ideas out there, given the macroeconomic environment? It will turn at some point, but given that uncertainty, what sort of stocks do you like?
Yeah, look, I mean, on the theme of what we're talking about today, just in terms of, stocks that probably potentially have been forgotten about that are probably related to the economy. I mean, I'll start off with G8 Education, which is GEM is the ticker. It's the largest childcare operator in Australia. It has over 400 childcare centres. It's been a tough company for a number of years. Our catalyst to buy shares was a couple of years ago with the announcement of the new management team, and they've done an incredible job. So it's a very simple thesis. The company's recovering from COVID and getting its occupancy back to what it was pre-COVID. At the same time, they're getting rid of some of the underperforming childcare centres and being very stringent on costs. And we've actually gone above 5% of this company, a substantial shareholder. And that's largely due to our views that we think the government's going to be very supportive of childcare and fund some of the cost increases that we're seeing around labour. So we think this business and the sector can actually achieve positive operating leverage over the next few years. And at the same time, G8 has a very good balance sheet. So we see the potential for capital management as well. So that's a company that's trading on 11 times earnings. Could easily trade at 15 to 16 times earnings once the market gets confidence on the strategy and the consumer environment. Another company that we like at the moment, ServiceStream, the code's SSM. Again, we're a substantial shareholder there. Company that used to be a market darling before COVID and was really benefiting from the NBN. Had to fundamentally change their business as a lot of the NBN work came off, the construction work, and has done so. And around 80% of their business now is pure maintenance. They're investing quite heavily to get into the defence sector. They've had one underperforming contract that's now completed in their utilities division. That's been dragging down their margins, but the next 2 years we think margins can increase and actually go from around 3% to 5%. And again, it's trading on a price earnings multiple of 13 times. I think we've got growth next year close to 20%. Its net cash has more cash than its debt. We think there's ability to make acquisitions. Good management team. So we really like that one. But I think just generally, if I was sitting here this time last year, I would have said the retail sector looks really interesting because we thought expectations were just too low in terms of the analysts following the sector. As I said, it had a really good period from November to March. It's been hammered since that point. But again, we're having a look at these companies again because a lot of the retailers in the space have another story, and that's what you generally want to look at for retail. Like you don't want just to, be looking at the same store sales growth or the store count for the next period. It needs something else. And so companies such as Premier Investments that's doing a spin-off of Smiggle and Peter Alexander looks really interesting. Very cheap, net cash balance sheet, great board, great management. That's starting to look interesting again. We think Harvey Norman looks interesting again. It's come off from well over $5 down to low $4s. The property by itself, I think, is worth $3.30, $3.40. So you're not paying much for the retail business. Beacon Lighting's got its own story with its rollout through the trade sector. So we're looking at those sort of companies at the moment because they have been really hit. I was just over in the UK. I think travel looks interesting again. I think travel's still going to remain quite buoyant. People are worried in the market about ticket prices, but this could actually be a positive for the travel agents because there's more incentive for the airlines to pay commissions to the travel agents, and also the ticket price is lower. You might actually see higher volume of tickets being sold. So Flight Centre we think looks really good there as they approach their 2% margin target. We're looking at corporate travel at the moment. We think that looks interesting too. So, I think in summary, you can't be invested heavily in the sectors such as technology and biotech this coming 12 months and expect to do well in the small cap sector. You do need to take some more calculated risks, let's say, on the consumer sector, because that's the sector that has the most value and that definitely has the most upside.
Oscar, thank you for talking to Fear and Greed.
No worries. Thank you, guys.
That was Oscar Oberg, Lead Portfolio Manager of WAM Capital, WAM Microcap, WAM Research and WAM Active. This is the Fear and Greed business interview. Remember, this is general information only and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.